Three major developments just unfolded within a 24-hour window. And when you connect them together, they paint a picture that most investors are completely missing. Individually, each headline looks technical, boring even. But together, they suggest that the silver market is no longer functioning the way people think it is. And if that's true, then the next move in silver may not just be a rally, it could be a structural reset. Let's break this down calmly and logically. 1. The policy shift that changes everything. This week, officials inside the U.S. Department of State confirmed that the United States is coordinating with allies to stabilize pricing in critical mineral supply chains. Now, most people skipped that headline. They shouldn't have, because silver is officially designated as a critical mineral under U.S. strategic resource policy. It's essential for solar panels, semiconductors, military electronics, electric vehicles, advanced weapon systems. And here's the key detail. Instead of letting volatile global markets dictate prices, policymakers are exploring mechanisms to prevent destabilizing price collapses that harm domestic producers. Translation: governments are acknowledging that the current pricing system does not reflect strategic value. That's not speculation, that's policy direction. And when governments move from free market observer to strategic price stabilizer, something fundamental has shifted. This is no longer just a commodity, it's infrastructure. 2. The producer signal. Nobody is analyzing. At the same time, one of the largest primary silver miners in North America, Hecla Mining Company, released record annual results. Revenue surged, net income multiplied, margins expanded dramatically. But buried inside the earnings report was something more interesting than the profit numbers. Their realized silver price was significantly higher than the quarterly benchmark average. Let's think about that. In theory, miners sell close to prevailing market prices. But when realized prices consistently exceed benchmark averages, it suggests something else is happening. Direct industrial contracts, off-exchange sales, long-term supply agreements, strategic buyers locking in material because industrial users don't care about paper volatility. They care about securing metal. And when buyers are willing to pay above spot pricing for guaranteed supply, it tells you that the paper quote on your screen might not represent true scarcity conditions. That disconnect between exchange price and real-world transaction price is historically what appears before structural repricing events. Not hype, not emotion, structural supply stress. 3. Retail demand. Just hit a breaking point. Now let's move to the demand side. The largest online precious metals retailer in the United States, APMEX, recently confirmed that after weeks of elevated demand and logistical strain, shipping times are finally returning to normal. At first glance, that sounds like a relief headline, but look deeper. For nearly a month, one of the most established bullion distributors in the country experienced delayed shipping timelines, reduced product availability, compressed inventory rotation, elevated call center demand that doesn't happen during calm markets, that happens during physical accumulation waves. And here's the key question. Did supply increase, or did demand temporarily cool after the recent price correction? Because markets often follow a psychological cycle. Price surge, buying frenzy, logistical strain, sharp correction, temporary demand pause, system reset, next wave. If the underlying supply deficit hasn't been resolved, and global mine production data suggests it hasn't, then normalization may simply be the calm before the next wave of pressure. 4. The options. Market is quietly setting up. Something big. Now, let's talk derivatives. There are currently tens of thousands of in-the-money call options on upcoming silver futures contracts tied to the COMEX. Each silver futures contract represents 5,000 ounces. If even a small percentage of those contracts were exercised with intent to take delivery, that would represent a significant draw relative to registered warehouse inventories. Now, historically, most options settle financially. Traders close for profit. They don't request metal. But here's what's different in this cycle. Industrial demand is rising. Strategic stockpiling discussions are happening. Physical premiums in Asia remain elevated. Producer margins are expanding. That creates incentive, and markets move when incentives change. If physical arbitrage becomes attractive, meaning silver acquired via futures is cheaper than silver sold directly into industrial channels, then exercising contracts becomes rational. That's when stress appears. The bigger pattern. Now, step back. Government policy is shifting toward mineral price stabilization. Primary producers are realizing higher than benchmark prices. Retail distributors experienced inventory strain. Options positioning is heavily skewed toward potential upside exposure. That's not random. That's layered pressure. And layered pressure doesn't always explode instantly. Sometimes it builds quietly until one catalyst forces repricing. Why this isn't just another silver spike. We've seen silver rallies before, short squeezes, retail surges, but those were sentiment-driven. This environment feels different because the drivers are structural. Geopolitical resource competition, industrial electrification, demand defense sector, procurement, growth strategic supply chain. Reshoring silver sits at the center of all four. That matters. Because when a metal transitions from investment vehicle to strategic material, volatility changes character. It stops behaving like a speculative trade and starts behaving like energy did during supply crises. The psychological trap. Most investors fall into. After a violent correction, most investors assume the move is over. They anchor to the high. They fear another crash. They wait. But sometimes corrections are engineered pressure releases, not trend reversals. Markets that are truly broken collapse and stay collapsed. Markets that are structurally tight fall hard and then grind back upward steadily. The current recovery pattern in silver is methodical, not euphoric, not parabolic. That's usually accumulation behavior. What happens? If this continues, if policy support firms up, if miners keep reporting elevated realized prices, if physical premiums persist, if delivery pressure increases, then eventually the paper benchmark must converge upward to meet physical demand, because the alternative is warehouse depletion. And exchanges are designed to prevent that scenario. Why media isn't covering this properly. Mainstream coverage focuses on inflation prints, interest rates, currency moves, equity volatility. But supply chain stress inside strategic minerals isn't headline friendly. It's technical, it's slow building, until it's not. And by the time it becomes obvious, the repricing is already underway. So here's the real question: if silver were truly overvalued, why are governments discussing price stabilization? Why are miners expanding investment? Why are industrial users locking contracts? Why are physical retailers experiencing strain? Markets don't behave that way at tops. They behave that way during transition phases. 1. The 6-year supply problem. Nobody fixed. Let's start with the simplest question. Is the world producing enough silver? The answer, based on global industry reports, is no. For multiple consecutive years, total global demand has exceeded mine supply. And here's the important part. Silver is not primarily a monetary metal anymore. More than half of annual demand now comes from industrial applications. That includes solar panels, electric vehicles, 5G infrastructure, semiconductor fabrication, military electronics. When demand growth is tied to technology expansion, it doesn't slow down easily. Solar installations alone have been accelerating globally, especially in Asia and the United States. And solar cells require silver paste, not copper, not aluminum. Silver. Even with thrifting efforts, reducing silver per panel, total installations have grown so fast that total silver consumption keeps climbing. That creates a structural floor under demand, not a speculative one, a technological one. 2. China's processing dominance. Now, let's talk geopolitics. While silver mining is distributed across multiple countries, refining and processing capacity is heavily concentrated, and a large share of global mineral processing flows through China. That matters because supply chains are no longer purely economic. They're strategic. When nations begin treating minerals as leverage through export controls, licensing requirements, or prioritization of domestic industries, the pricing mechanism changes. Silver has already been categorized in multiple jurisdictions as strategically important for renewable energy and defense. When metals move from commodity to strategic asset, volatility doesn't decrease, it increases, because politics enters the equation, and political decisions don't follow normal supply-demand logic. They follow national interest logic. 3. The solar demand curve is exponential. This is the part most investors underestimate. Global solar capacity additions over the past 5 years have not grown linearly. They've accelerated. Every year has been larger than the last. The International Energy Agency has repeatedly revised solar forecasts upward. And every gigawatt of installed capacity consumes measurable silver. Even if manufacturers reduce silver per unit by 5 to 10%, total installations rising 30-40% per year still increase overall consumption. That means silver demand tied to energy transition is not cyclical, it's policy-backed. Governments are subsidizing it, banks are financing it, corporations are pledging it, and that makes demand more durable than traditional industrial cycles. 4. Defense spending is quietly rising. Another underreported factor, global defense budgets are expanding. The United States, Europe, and parts of Asia are all increasing military procurement spending. Advanced radar systems, missile guidance, satellite systems, secure communications, all rely on high conductivity materials. Silver's conductivity is unmatched. It isn't easily substituted in high-performance applications. So while investors focus on retail coin demand, the larger driver may be industrial and defense consumption, quietly pulling material off the market. And defense demand doesn't disappear during recessions. It usually increases during geopolitical tension. 5. The inventory illusion. Here's something most people misunderstand about exchange inventories. When you hear that a futures exchange holds tens of millions of ounces, it sounds like plenty, but not all inventory is available for delivery. There's a difference between eligible inventory. Registered inventory. Registered inventory is what's actually deliverable against futures contracts, and registered stocks fluctuate. If registered stocks decline while open interest remains high, leverage increases. That doesn't automatically cause a crisis, but it reduces flexibility, and markets under reduced flexibility react more violently to shocks. 6. What could trigger the next leg? So now the big question, what actually ignites the next explosive move? It won't be a YouTube video. It won't be social media hype. It will likely be one of 5 catalysts. Catalyst 1, policy confirmation. If Western governments formalize price stabilization mechanisms for critical minerals, investment capital will front-run the move. Catalyst 2, industrial delivery. Stress if a major industrial user publicly confirms supply difficulty or long-term contract premiums, markets will reprice immediately. Catalyst 3, exchange delivery spike. If delivery requests exceed comfortable warehouse buffers, volatility will surge. Catalyst 4, geopolitical export restriction. If any major refining nation restricts exports of processed silver products, the shock would be immediate. Catalyst 5, monetary instability. Silver remains a monetary metal historically. If confidence in fiat systems weakens, precious metals receive safe haven flows. Any one of these alone could push prices higher. 2 at the same time, that's when repricing accelerates. 7, why corrections? Don't invalidate. The thesis. Some investors see a 40-50% correction and assume the cycle ended. But structural bull markets and commodities often include violent drawdowns. Oil did this in the 2000s. Copper has done this repeatedly. Gold did this between 2008 and 2011 before tripling. Volatility does not equal invalidation. In fact, high volatility often appears during supply transitions because markets struggle to find equilibrium. 8. The gold-silver relationship. Gold has been regaining strength recently, and historically, silver lags gold before outperforming. When gold stabilizes at higher levels, silver often compresses the gold-to-silver ratio during the next expansion phase. That doesn't happen overnight, but when it happens, it tends to be sharp. If gold maintains strength while silver demand fundamentals tighten, relative valuation, all one, could justify upside repricing. The psychological phase. We're in markets move in emotional cycles. Disbelief, acceptance. Excitement, euphoria, collapse. Right now, silver sentiment feels like disbelief mixed with confusion. That's not a top. That's usually mid-transition. True tops feel euphoric. This doesn't. It feels tense, and tension builds energy. The real risk most aren't considering. Here's the overlooked scenario. What if the market doesn't explode upward? What if it slowly grinds higher for months while inventory quietly tightens? That's more dangerous for short positions. Because slow trends force continuous repositioning, and when positioning gets crowded on the wrong side, moves accelerate unexpectedly, not because of conspiracy, but because of leverage mechanics. So where does that leave us? Let's connect everything clearly. Multi-year supply deficits, accelerating solar demand, rising defense consumption, strategic mineral policy shifts, exchange inventory constraints, options exposure, growing geopolitical fragmentation. This isn't a retail hype story. This is a structural resource tension story. And structural stories don't resolve in a week. They resolve in cycles. Final thoughts. The biggest silver moves in history didn't start with headlines screaming, "Buy silver." They started quietly, with policy shifts, with supply contracts, with inventory tightening, with structural changes beneath the surface, and only later did the price chart reflect what was already happening. If the pattern unfolding now continues, the next phase may not look like the last spike. It may look more controlled, more policy-supported, more industrially driven, and potentially much larger, because when a metal becomes strategically necessary, it stops being optional.